Welcome to On the Mark, Financial Literacy with Mark Zinman. This is part 2 of the Reality of Paying Taxes series. If you have not already watched part 1, it's not too late to check it out because in this episode, we pick up where we left off last week.
Are you thinking about how it's affecting 26 or beyond 26?
All the above. It depends on the client. I mean, I have a client who does fantastic every year. And if I ask him every year when we have lunch in December and I'm doing his tax planning, what's next year? Oh, Mark, next year it's going to be horrible. I have no contracts. I don't think we're going to make any money. And he's been my client for 25 years and I hear the same thing every year and I just ignore him at this point because what he says is because he internally feels like he's starting over every year and it feels like he has to climb that mountain and he doesn't want to take anything for granted. So his initial thing is going to be, I don't make any money. But history proves that he does, so we make our recommendations based upon not how he feels, but what we know.
And what you anticipate is going to happen in the future.
Right, and we never anticipate tax law changes. We anticipate the tax law changes that may be going into effect, but we don't assume that Congress is going to pass a tax law in 26 that's going to materially affect 26, and therefore we should have made a different decision in 25. And it's the same reason why we try to keep our clients informed when there's a tax bill maybe going through Congress, but people get confused on sometimes what is being proposed versus what has actually been passed. They further get confused about what is currently in effect and what is going into effect. So even with the current year tax bill, a lot of the extra deductions are really 26 and 27 deductions, not 25 deductions. But yes, they are in the tax bill. So that's what people hear and they say, okay, well, I know I'm going to get an extra exemption this year for my Social Security. No, you get that in 26.
What else are you seeing clients come to you with that you think may be, I don't want to say unrealistic, but I would say they're coming to you having heard that they don't have to pay taxes if they had the right guidance?
I've often had this joke that somebody will come to me and say, and this guy told me that he knows somebody who does taxes and he never has to pay anything. So can you give me his name? I'd like them to prepare my taxes. Okay? So what we are trying to do is we're trying to take an emotional thing and make it rational. Plan. No surprises. I mean, for the most part, for our client base and for anyone who's using a tax professional, you should pretty much know what April 15th is going to look like December 15th or whenever you do your tax planning, okay? Within reasonableness and with some materiality. I mean, if you're off by a few percent one way or the other, that's to be expected. But we shouldn't be having people get calls on April 10th with numbers, especially negative numbers when they owe something, that they're surprised at. And they're scrambling. It's the biggest complaint I hear. We get clients all the time, and this is the complaints we hear. I can't get my accountant on the phone. He doesn't return my calls. I get my stuff at the last minute, or it doesn't get done on time. And I get these phone calls that I owe a bunch of money when I didn't know about it. And our goal in life at Zinman & Company, and it should be for every professional, and I'm not saying that there aren't plenty of other ones that do the same way you do. I'm just saying this is what I hear when I get clients that are dissatisfied, not the happy ones, is that the client, everything should be planned and known and discussed and provided your options. But in the end, you can't pay no taxes. You just can pay the amount that you can control.
But I also hear you say, Mark, that you are a huge proponent of providing real-time advisory services as opposed to trying to make the best of a historic event. So one of the things as we start to wind down today's episode that I thought you might speak to is how important it is. And thus far we've been focusing upon perhaps a small business owner, but for an individual perhaps that just received an inheritance, they should not certainly delay communicating with whichever professional they are relying upon to provide them with sound financial advice. And discuss what they did and then how do they react to what they did, but rather when that event occurs, such as receiving an inheritance or making a large purchase, speaking with their tax accountant and seeking their advice at that time.
Well, you mentioned real time, and I just want to say, so the client that we had this conversation today about the taxes, we just finished up his September quarter. So when he said to me he wanted to go out and buy vehicles, and this was his reason, I was actually comparing that reason to actual numbers. It was less of a philosophical discussion than a factual discussion. It's the same thing, like the worst thing that a person can say, I can say, is we could have. So we want to tell clients that we're consultative, and you should have a person who is consultative, whether it's an investment advisor, a lawyer, an accountant. They should be consultative in the fact of being proactive and make you feel that you can be proactive to disclose things so that it can be discussed. So even the client today who we talked about their inherited IRA, they didn't know that they don't have to pay inheritance tax. I said, no, the inheritance tax has already been paid for by the estate. You just have to pay the income tax, and the only reason you have to pay income tax is because you step into the shoe. So when you get an inheritance, you step into the shoes of the decedent. So that person would have had to pay taxes, therefore you have to pay taxes. However, if they gave you your bank account, which they already did pay taxes, then there are no taxes, right? Right. So you step into those shoes, but it has to be discussed. And the same way that we had a discussion with the client today about, well, it's better to split the $150,000 or $160,000 over 3 or 4 payments than one. Yeah, everything. Planning is essential, and that's the whole thing. Like, you should have someone in your life, and including your financial advisor, because that's another big one. Because you don't want surprises from that either. We're going to talk about capital gains in another episode. That was something we talked about today, and then I came in all fired up about taxes. So he said, "Well, you're fired up. Let's do it."
Yeah.
But like dividend-paying stocks, a lot of times mutual funds usually pay out their dividends and their capital gains at the end of the year, and they're often a surprise because nobody knows until they declare it. So like a mutual fund, all year long will be buying and selling stuff, and you get a dividend. That's probably the dividends inside of it, but at the end of the year they pass out the capital gains, and depending on what that's where you hear things about tax-efficient investing or buying ETFs, because there's less of that unknown income that all of a sudden going to show up. And the funny part is, like, clients all the time. This is another one. Like, they'll have, they'll end up having, say, $100,000 gain, and they'll say, $100,000. Where's the money? Well, the money was in their investment account that was $300,000, then the next month it was $305,000, then it was $320,000, and they never took the money out, but now they got to pay tax on $100,000, and again, it becomes emotional. Well, where was the $100,000? If you really wanted to, you should say, I have tax on $100,000, and I should ask my investment advisor for the 20% capital gain rate out, and therefore now I'm not paying the taxes, but the investment's paying the taxes.
Right.
And it's the same reason that we always say, when we're doing tax planning, that we don't want our clients to reach into their pocket to pay. We want them to have the money available, either have planned it ahead of time or have the money put away in their business to pay it.
And we've talked about that.
Yes, absolutely. Again, we're trying to take an emotional topic and make it factual and rational. And if you start, I don't know if I said it in an episode, I know I said this to a client. When you are an employee and you get paid $1,000, you go home with $750. When you're an independent contractor and you get paid $1,000, you have $1,000. You still have to pay that $250.
Right.
But the difference between the employee is you never see it. The difference between an independent contractor is you got the $250, and you have to be disciplined enough to know that's not your money.
Right.
And that's how businesses get into trouble. And that may be a very small, but multiply that out times 52 weeks or 52 payments or 3 or 4 years, and it starts to really add up, and it becomes a problem because now a person says, well, I made $1,000. What do you mean I got to pay $250? I didn't know that. So knowledge is power. And again, it's all perspective, right? The perspective is, if I knew that I owe $250 out of that $1,000 and put it away every week, I wouldn't be upset about paying $250 times the number of payments I got for taxes. But I'd be upset about paying that same amount of money if I didn't segregate it.
Right.
So what I'm saying is all mental.
Right.
And it's all mental because taxes are emotional.
Yeah. We'll ask
And your accountant here is emotional today.
We'll ask Alicia if she'd be so kind as to include a pop-up on today's episode that references back to that episode.
Okay.
And we're excited. I often hear you and all of us at the team talk about our clients and how grateful we are to have them and the relationships that we've forged with them. And your energy on this topic, I think, is indicative is that this is something that you do for a living and you enjoy it and you're passionate about it and you care about making sure that your clients are provided with the best possible advice with the best possible outcome. So it's good to capture that enthusiasm.
Right, but so the relationship that I build with clients is what gives me the power and the influence to get them to do what I think they should do.
Gotcha.
And which they're grateful for most times after the fact.
Yes.
I'm not saying that a client wouldn't be grateful to pay no taxes this year and then deal with the consequences, but they have historically been grateful for that advice and the guidance of the choice because they see the benefit of, happiness one year, sadness one year. Let's just be like, okay one year and okay the next. Let's not be too high or too low.
Mm-hmm.
But
Okay, all right, good. Well, we're going to kick capital gains back to next week. but
unless I get a phone call from a client like the morning of a podcast, and then we can have a new topic.
But I want to thank you for sharing those examples. Hopefully that will help motivate some individuals to have early conversations with their tax professionals. And thank everyone for joining us for today's episode. We look forward to seeing you next Wednesday. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.